Hello, everybody, and welcome back to video number 5 in Chapter 3. Here we're going to look at company disclosures, and that's where we left off, the allocation approach. And here's some examples. I can let you read those on your own, how we determine our pricing. So let's take a look at that. Skipper Marine sells boats, provides docking slips for its customers. Skipper sells boats for $30,000 each and provides mooring facilities for $5,000 per year. So to promote sales, they enter into a contract to sell a boat combined with 1 year of mooring services to a customer for $32,500. Skipper concludes that the goods and services should be accounted for as separate performance obligations. How should Skipper allocate that transaction price to the performance obligations? Well, I think this one's pretty straightforward. The transaction price of $32,500 is allocated to the boat sale and moorings services based on their relative standalone selling price. So here's their relative standalone selling price of $30,000 plus $5,000 here. And now we'll take $30,000 as a percentage of $35,000. We get $27,857 for the boat, and $5,000 divided by $35,000 to get $46.43 for the mooring services. So the bundling of the boat and mooring services that provides the customer $2,500 discount, and we allocate it proportionally to the two performance obligations. So now we'll take a look at recognizing revenues. Here again, we have some examples of Nike, how they do it, and how General Mills do it. And again, I'll have you read that from the textbook. Let's take a look at an example. Here, Amazon on January 1, 2025, sold 100 fitness trackers at $36. So the total proceeds was $3,600. In addition, it sold an extended 2-year warranty on 40 of that 100 fitness trackers for $12 or $6 per year because it's over 2 years. So recall that the extended warranty takes effect after the regular 1-year assurance warranty expires. Okay, so how should Amazon report this information in 2025, 2026, and 2027? Okay, let's look. The solution, therefore, is that Amazon is going to satisfy the performance obligation related to the fitness tracker, along with any cost of goods sold, but we're looking at just the revenues here. So therefore, Amazon recognizes the $3,600 as revenue in 2025. In addition, Amazon recognizes revenue over the time the revenue related to the extended warranty services. Therefore, the warranty revenue is going to be $240 over the 40 periods here at $6 per period. Now you remember, here it is, $6 per year, and there are 40 of these fitness trackers. So each year we've got 40 trackers at $6, $240. It is recognized in 2026, and the remaining warranty revenue of 2040 is recognized in 2027. So each year gets $240. Okay, let's do a long one here Backup company manufactures emergency power equipment. Its most popular generator is a model called the Acctg, which has a retail price of $1,500 and costs $740 to manufacture. It sells the Acctg under a written contract, which indicates the customer's and backup's right and responsibility on the sale of each Acctg. Collection on the contract is probable, so backup sells its generators on a standalone basis directly to customers, as well as provides installation services. Okay, installation services are not specialized, and customers could hire other vendors for these services. Backup sells 30 generators with an installation to a chain of convenience stores to provide uninterrupted power to its self-service beverage coolers for the total contract price of $50,000. Backup provides installation services on a standalone selling price of $200 per unit. The cost of backup to install is $150 per unit. The generators are delivered February 1, 2025. Installation is completed on March 15th, 2025. The whole payment is made to backup company. Okay, let's look at the 5 steps of that revenue recognition model for revenue arrangement. The sale of the generator and installation are accounted for as separate performance obligations. What amount of income related to this arrangement would be included in backup's 2025 income? Assume now that the customer promises to pay backup 3 months after installation. Briefly discuss how collectability of this payment affects revenue recognition and income measurement for backup. Okay, so with respect to the 5-step model, we're going to identify the contract. We're going to identify the contract here. Identify the performance obligations here. Determine transaction price. Transaction price is $50,000 as specified in the contract, and backup expects to receive in exchange for the goods and services. So, in 4, we have to allocate the transaction price. The total price should be allocated between equipment and installation. So how do we do that? We take $45,000. Let's go back. Here's the 45. And we get that $45,000 by taking the 30 generators here multiplied by it 30 generators multiplied by its retail price of $1,500. Okay, that wasn't terribly obvious, I think. And we have the 45,000, and then we divide that by the 51,000 times 50,000 total transaction price. So that 51,000 is obtained by taking the 30 generators at 1,500 here at 45,000, and then the installations at another 6,000. That gives me 51,000 at a standalone price, but I'm doing the little beauties for $50,000. Okay, so I can say 44,118 is equipment, and another 5,882 is the installation. And that's how we're going to recognize revenues in this case. Okay, the installation revenue is recognized on March 15th, and that's when we have completed our performance obligation, and for the installation. And then we're also going to show that we've transferred those generators, and that portion is going to be done on February 1 here. Less, of course, the cost of goods sold that is associated with generating that revenue. Okay, so here we go with the income, cost of goods sold, gross profit, installation revenue, installation expense, net profit from the installation, and the total income on this agreement. So we're assuming both the delivery and installation occur in the same accounting period. And of course, the income would affect the entire arrangement, would appear in this single period's income. If it's not possible that the company will get paid for satisfying a performance obligation, then the existence of a valid contract is questionable. If collection is only probable, backup cannot recognize revenue until that payment is probable. Only then, or when all amounts are paid, can backup recognize the revenue on this contract. Okay, let's take a look at describing the concept of earnings quality. Here, companies have incentives to manage their income to meet or beat Wall Street expectations, so that the market price of the stock increases, the value of management's stock compensation packages increases. Very important. So the quality of earnings is reduced if earnings management results in information that is less useful for predicting future earnings and future cash flow. Earnings management is often defined as the planned timing of those revenues, expenses, gains, and losses to smooth out the bump in earnings. In most cases, management uses earnings management to increase income in the current year at the expense of income in the future years. Okay, non-GAAP reporting. Some companies go to great lengths to present their results in the most favorable light by implementing some non-GAAP reporting. For example, Groupon here presents some information on the next slide. So here it is, Groupon, and here's an adjusted, commonly used terminology here: earnings before taxes, depreciation, and amortization. A quick method of computing cash. Okay. So Groupon management indicates that the adjusted EBITDA is a non-GAAP financial measure that comprises net loss, excluding income taxes, et cetera, et cetera, et cetera. Management also indicates that the definition of adjusted EBITDA may differ from similar measures used by other companies, even when similar terms are used. So adjusted EBITDA is a key measure used by our management and board of directors to evaluate operating performance, generate future operating plans, and make strategic decisions for the allocation of capital. Accordingly, we believe adjusted EBITDA provides useful information to investors and others in understanding and evaluating our operating results in the same manner as our management and board of directors. All right, this looks like a good place for us to stop this video. And when we return, we'll take a look at reporting accounting changes, estimates, and errors. Until then, bye for now.